Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon. Today was nothing has changed. This is the part that's very interesting because I listened to the speech from Powell, and his commentary was for the most part, pretty much bang on the same stuff as he was talking about in December. And all we have right now are not really extremes, but just things at the risk ranges, whether it be the top end of the range on something like an equity, like the SPYs and Qs and small cap in the Russell, or if it's the inverse of that, aka volatility, they're at the low end of the risk range with VIX down just under 18. So these are things where, again, you're seeing, if depending on which parameter or which time frame you're looking at, but if you peel things back on, say, the Qs here, and you go back to the August, so okay, let's peel back, and I'm not trying to cherry pick because we're now above the November highs, which is fine and dandy, but we're still significantly lower than the August highs of that 335-ish range, and we're sitting here around 300, or pretty much right at 392 cents. So this is where, again, with the data that keeps flowing in, and the depending on the outlook, really it's just a matter of executing on the fringes. And right now, we should be executing on the fringe, setting up for next month, next quarter, et cetera, et cetera. So that's the core message I want to get across today. Is nothing has changed in terms of the overall economic data outlook, and I think in general, Hedgeye is doing a pretty good job of continuing to convey that message to everyone. And here we are. I'm sure there's lots of frustration out there in regards to, it's been a hell of a start year to date, right, in terms of U.S. equities in particular. But the global framework and the equities that we do have exposure to, like precious metals through GDX or GLD or silver, or certainly China in most recent weeks, these things are performing well. So again, it's a matter of what is your portfolio construction, what is my portfolio construction, how does that look, and parsing that with and pairing that with, the economic data that is flowing in or that is anticipated to come in. So, I think with that, I got Mitchell from Other Side Asset Management who's coming up, and I don't really want to be like I'm at a bit of a loss for words here, but I am. There's only so many ways that we can keep conveying the same message, because I think with patience and continued due diligence of executing incrementally, that is likely, has a high probability of paying off, given the nowcast model and the data that we're seeing and what we anticipate to see in terms of recession risk on the horizon, and the fact that few are talking about that, and it's still very focused on inflation, focused on what the Fed is doing, the Fed pivot. That isn't happening clearly. And going from there. Mitchell, the floor is yours.
Yeah, sorry, buddy. I don't have a ton of time, but I wanted to just echo off of what you said. I don't think you could have started off better. Portfolio construction, right? It's not as if you guys don't have 20 plus longs. So I think everybody who's voicing their frustration is voicing their frustration over their short bias and getting too over their skis on their short bias, because things have been moving through the top ends of the early morning daily published ranges. It's not like we haven't been through this like 4+ times, right? So I was down about 10 bips today. I have a short bias, right? At the same time, gold miners, China, KWeb, EWH, EPHE, SCO, short oil, right? Oil failed to trend, short oil. So all of these things were up today. So yeah, I would love to be crushing it on the short side and just be, really, really short. But the process, A, has patience embedded in it. B, it also talks about portfolio construction. At the same time, it talks about playing the game that's in front of you. So we have the short bias. When we start seeing top ends of the risk range, lower highs, 3-4 days in a row, similar to Europe, Germany, etc., then you should, in theory, start to have a little bit more confidence on that short side and skew your portfolio towards that. Do I think that we're going to have a VIX spike into the 30s? I do. Do I think we're going to have a credit event? I do. Would I like to be, minus 50 to minus 75 net short? I would. But it's just not the market that's being played right now. You got 18 to 21 VIX. So we know what the playbook says. We know what's kind of in front of us. We know what's looming. You also have some outside forces at play. You have the ODTs, right? ODTEs, right? So until somebody gets crushed in that, until somebody starts selling the puts into somebody's face who's buying the calls, until that happens, or buying puts, not selling puts, buying puts in somebody's face who's buying the calls, and it goes the other way until somebody gets really hurt, we could see, looking into February of 2020, Tesla nearly doubled, right? Until everything collapsed. You can see some really crazy shit happen in these markets at the edges of the ranges, large in part because many of these institutions, whoever's been on the institutional side, they try to save themselves by doing crazy shit without wanting to expose that they're about to blow up. It just is. So Robert, not an easy call to get on with people having such high anxiety. At the same time, and I would love to be more long. I still have a short bias. So I still think that things are coming. At the same time, I'm playing the hand that's in front of me. I don't have everything that's long in the, macro pro sub, but at the same time, I do have quite a few. And on those down days from the other day, I added more and I got a better position. So my net was better off to deal with a day like today. So you can either risk manage or take bets. The process helps you risk manage. So this call helps you get better. So I don't think, I'm not saying that you are, but I don't think you should be on the defensive one bit. I think you should be talking notebook, talking process, because the process has us in XYZ and there are plenty of longs and, let's roll. Let's not whine about it. Let's play the hand that's in front of us, which is VIX 18 to 21, which is plenty of longs. And and we know what the outcome or the probable outcome is going to be. So as we start to see those incremental increases in the higher lows in the dollar, or we start to see the incremental increases in the higher lows in the VIX, then we can start to be a little bit more aggressive on the short side. That's all I have to say. I appreciate you doing this, Robert, and I'll, drop back to being a listener, but you're doing a great job, and Hedgeye is putting us in a position to win. We just have to be accountable to ourselves and say, well, have we bought the longs or have we not? So that's all.
No, I appreciate that very much, and thank you. I one thing in terms of signals, excuse me, I shouldn't say the XLE was neutral on January 26th and then turned bullish on the 27th, and has maintained this bullish signal strength as of this morning. But in terms of sectors that were down on the day, and again, I'm not trying to position this call in like a bearish stint, but to your point in terms of notebook stuff, that is certainly something that should be circled, and it'll be interesting to see whether or not the recent move down to kind of that 88 level and being down 2% on the day, how is that going to impact the signal, and where does that kind of like trend level sit currently on key signal? And so that would be one that, again, we don't get the risk range daily, but it's in the out bucket. We get the signal. I would be circling that one because it's teetering. The crude oil signal continues to sort of failed right at trend last week, which I called out over the weekend. That was a big thing that was circled in my notebook, was how that acted, especially this past Friday, and really how it's continued to act this week. It did have a big higher low this morning, but that was the day after putting in a massive lower low yesterday in the risk range. So I'm keeping a keen eye on that. The other component there in terms of just in the energy space, natty gas, that signal continues to put in lower lows and lower highs versus the precious metals, as you said, other side in terms of gold, copper, silver. Those continue to pick up strength and keep putting in. Oh, sorry, not silver's kind of flat, consolidating the risk range, but both copper and gold keep putting in higher highs and higher lows. So just definitely wanted to call out those two signals. The other component there as well, in terms of global macro environment, the DAX was kind of flat on the risk range, but it keeps putting in, or kind of, if you go back over the course of this week and sort of like week over week, those are lower highs there that it is putting in as well. So Europe is definitely setting up. That was a topic 2 weeks ago. So we skipped last week just from traveling, stuff like that. But Europe was certainly something that we were reviewing. And Trend, I know, who just jumped on, he's been, we've been both short Europe, and so, but regardless, that looks like it's something where, adding back to that, or that's moving up the list in terms of the short list. High yield, and Keith hit the button on junk today, but high yield certainly is moving up that list on the short side. And conversely, the Nikkei today, kind of, I put a question mark next to that thing. That signal's kind of, put in a higher low, a bit of a higher high. So will be interesting to see if the Nikkei, basically captures or sort of moves or sort of gains a wee bit of strength from the rest of Asia, because the rest of Asia, again, components of it like Philippines, Thailand, Hong Kong, those components are certainly ones that we have added recently from an EM standpoint, and certainly China continues to look like a place where you want to have capital deployed. So if you don't like China, there are other components in EM that you can go and explore, and even Australia would be one that we don't currently have on the board, but certainly has a read through to other components from a commodity, from a precious metals type standpoint. They have typically do trade in some form of correlation with kind of commodities and more so on the precious metals / base metal side versus energy in particular. But definitely components there that you can kind of gain exposure to and have a little bit of a proxy to China and that kind of thing. So those are definitely things to be calling out. The volatility across the board. Gold vol continues to look excellent. Oil vol spiked last week, but has sort of come back in, certainly on a day-over-day basis. So, but likely, hold on, let me pull up OVX. I think it exploded today, at least coming into the day. Well, no, it was down actually. So down on a down move in oil. That's an interesting component. So kind of blends into what I was really trying to get at, which is, volatility really across the board, whether it's VIX, RVX, VIXN, GBZ, FX vol, even the move. The move is now down to a 93-ish level. No, where was it? 97.3. I knew there's a 3 in there. 97.3. So again, volatility continues to be kind of suppressed, and whether that's artificial to Mitchell's point, which there's certainly one would say is a component there that is playing out. But also you just got to play the game that's at hand, and that's where assets are being bought, right? Like in terms of across the board, like capital flows to where volatility is decreasing, and that's what's happening right now across the board, and it's been happening for the last few weeks as you continue to see, the big lower high this morning in the VIX at 21.66. That was circled, starred, exclamation pointed. So, that 18 range to 18 to 21 and a half, 21 and three quarters should be a big call out on everybody's page. The weakness in healthcare, the strength in healthcare, but the weakness in XLU, that signal sort of, although a higher low, it did put in a lower high this morning and really didn't move much on this equity move this morning. So that can be a big tell when the market is when general equities are bid in terms of the S&P up 1%, and an asset that's been working, that's bullish trend like Utes, doesn't kind of catch the bid as well. That can be a tell. So that was kind of squared on my page today. If that doesn't kind of improve over the next couple days in terms of kind of moving into next week and repositioning, the Utes are going to are certainly moving down the list, and I'll leave it at that. So Trend, welcome, my friend. Such a pleasure to have you on. Thanks for joining.
Hey. Well, I hope everybody is well hedged. We had a very interesting day today with the Fed giving further dovish stance in terms of what they expressed in December. Actually, what they expressed in December when somebody was trying to decipher it using natural language processing, it came out to be a bit on the dovish side. And then furthermore, we saw dovish stance in general. And then commensurate to that, we saw the overall rally. Also in the after hours, we're noticing Meta having a huge run up. I think Freebird had mentioned about Meta in today's 12:30 call. So those who attended it, definitely in the after hours, you're seeing the impact of that. Freebird had a session in which he had mentioned about Meta having almost a 35% upside. But this is specific to Meta, not to the industry, not to the markets. It's just long on the long short side of the book. From my observation perspective, Rob, for my European side of the book, I am stopped out on most of my European put verticals that I had because they hit the 50% mark. And then on the
just for the record,
overall,
me too.
I actually,
Me too, Trent.
yeah, I flipped bullish on that with the BBEU ETF, which is from JP Morgan. Few days ago, one of the factors that I do look into is the ETF fund flows, and BBEU was having some increasing acceleration of fund flows at about almost 200-300 million a day, and it continued for good close 10 trading sessions, such that its AUM went from $3.5 billion to $7 billion. So fortunately, I was able to capture part of that upside. Similarly, there's another one called BBJP, which is what I use for Japan. I do use sometimes EWJ as well, but BBJP gives a bit more juice. Australia, I'm long EWA. Other than those three, on international, I don't have a whole lot to add. On the other ones where I got stopped out, haven't taken any huge long positions. As I mentioned, BBEU is more of a composite of multiple European stocks, which they've created as a basket to trade based on certain indices. Next one is AAXJ. I think I mentioned that when you're tweeting about something on international ETFs. AAXJ is Asia X Japan. It's having a very good, strong signal as well. Other than that, within the sectors, I wanted to mention XLK is giving a very interesting signal at the moment in terms of where it wants to land, where it plans to land in terms of this is barring the macro aspect, right? Macro aspect, they are definitely suggesting, as well as fundamental aspects are suggesting that semiconductors, which form almost 40% of XLK, should get hammered from here, predominantly because of the nature of their cyclical business. But in the very short run, you don't trade with fundamentals. In the very short run, you trade with signal and momentum. And as far as my signal is concerned, it's showing me one has to stay long on some of those names. So I'm long Broadcom, I'm long Oracle, KLAC, and a few others. I'm definitely not long NVIDIA or anything like that, which might have some excessive beta to it. LRCX, I was long. I booked profits in it today. And LRCX, actually, I bought it when there was a huge sell-off during the tax loss selling because it was a bit excessively done. And then with about good 25% gain, I was able to get out. I am long Apple at the moment going into the print. I don't plan to hold it into the print. It was predominantly a sort of a hedge for some of my other shorts that I have in the tech sector. Outside of that, in currency, I continue to express my short dollar uh, theses in form of yen. So it's not a short dollar thesis as such. It's more of a long yen thesis against the dollar. So I'm long yen against the dollar. I think it has a long way to go from a risk reward perspective. It's favorable. I don't have a view on euro versus dollar, but based on what's happening in Europe, seems like euro would further strengthen. So if you look at two major currencies, which is euro and yen, they form about 2/3 of the basket on Dixie or more, and that's where Dixie's inherent weakness will start showing up. Outside of that, in metals, I'm long platinum, some silver, some gold. I got stopped out on USO, which was oil. And there's one other interesting position in rates I wanted to discuss. So Simplify has this ETF called PFIX. And it's interesting that today's event actually led to PFIX going down. So PFIX is nothing but a bunch of swaptions that the Simplify team has gathered. Retail usually does not have access to these swaptions. So if the interest rates were to go up, because usually what happens is on the day of FOMC, you'd see that there's overall buoyancy in the market. The Thursday after, there's a sell-off. And I'll share in the tweet nest above, which is also in my Twitter timeline, which shows that on an average, on an FOMC day, the performance of SPY, IWM, QQQ, and VXX tends to be more on the risk on side. And then the day after, which is Thursday, it tends to be on the risk off side. So definitely take a look at that. This is for the last 7 FOMC meetings. So hoping tomorrow would be some sort of sell-off. If we do get, great. If we don't get it, then we shall continue. But the reason I brought that up is because PFIX tends to give some interesting response function for this kind of a setup. I've used it for a few events in the past. I don't know. Again, this is not an advice, right? I don't get any compensation from Simplify. I'm just sharing a trade tactic I've used in the past. So towards the close of trading today, I did go long PFIX at about 58 and change, hoping to close it at 61 and more tomorrow. So let's see how it works out. That's the strategic and that's the tactical. Rob, back to you.
Thank you, Trent. Always a great rundown. I appreciate that. I know you briefly mentioned Meta there. I do think it's worthwhile reviewing that because if peeling it away from Meta itself, if you dive into the XLC components, and really from a there is about 21% or almost 22% or a little over 22% exposure to Google, which has a bearish signal in terms of our on the page. But the other big components are Meta, Disney, Netflix, T-Mobile, Charter, Comcast, and AT&T. And a number of those, not to give away Freebird's coverage list, but a number of those, we are favorable on. And certainly Netflix, which, many of you listening in from the risk range product have seen for weeks, if not months now, that has been bullish trends. So, and Meta has been teetering on neutral, it's on neutral today, kind of teetering on bullishness. So, I just wanted to call that out because I think if you haven't gotten long, or if you're not comfortable getting long EM, which is understandable, right? Like many folks have compliance reasons why they really need to keep either those positions on the small side and or not at all. There are certainly components here and communications in general, although I got to look. Hold on a second. I kind of forget if they are along. Give me 30.
So
Yeah,
Rob,
go ahead.
on comms, actually, a whole bunch of tickers have, in the short run, fairly strong signal.
I would completely agree.
Yeah.
Which is another reason why I'm
on
calling it out, right?
Yeah, understood. So both at the sector level, it's one of the strongest sectors in S&P 500 in relative strength terms. And then on a more short-term tactical basis too, some of the names in it are in an extremely strong momentum. So Warner Brothers, Discovery, Match, Paramount, Disney, Meta, Netflix, Google, all of these have extremely strong momentum signal in relative strength terms. Again, not in absolute terms, in relative strength terms within the XLC basket.
And I was just triple checking. What I wanted to do is on the quad regime, kind of expected values, highest, lowest. Telecom does rank in there in terms of, staples, Utes, REITs, healthcare, telecom, in regards to, again, this is traditional, back-tested, things that work well in a quad 4 environment. So it'll be interesting, and I'm calling it out because I think this is, potential where in 2022 comms, did not work at all in regards to performance and what have you. In fact, it was a joke that they were just an absolute dumpster fire all of 2022. So perhaps here in 2023, with better year-over-year comps and slightly easier comps for a number of these assets within the XLC component itself, perhaps this is one where this perhaps replaces staples, which just lost signal strength in the last week or so and has turned bearish trend. So again, just wanted to call it out, put that on the radar. It's really something that I have noticed, especially to your point, trend in terms of on an absolute basis in regards to strength itself, just purely from a price standpoint. It has been it was one that I highlighted over the weekend, and it continues to have strong performance on a year-to-date basis. It's the second best performing communications at a little over 16%, just behind XLY at 17, and XLY, obviously, has a big component there in Tesla, and that has been, has had a big move post earnings last week, I guess it was. So just wanted to again call it out. It's up in XLC. If we go beyond just year-to-date, aka last month, XLC on a 3-month basis is the leader at a hair under 16% in terms of just absolute returns. So again, just something that I think if it's not on your radar, should be put on your radar. And I'm not, this is not advice, it's likely pushing the top end of the risk range. So, be patient there. But if it continues to maintain, to Trent's point, strength on an absolute basis, then could be one that could be added to the portfolio there from a U.S. sector exposure standpoint.
And SAM's actually developing. This is, of course, developing for XLK also, because broadly speaking, and it does have a mix and match. So it has a trend on the semis getting close to exhaustion, but then the rest of the XLK is just getting warmed up. So Apple and a few other names and that are getting warmed up. So relatively speaking, XLK is also trying to show some degree of outperformance, be it on a broader trend basis or even on a immediate tactical day over day basis. I do see XLK having significant relative strength within the sectors and S&P 500 because the defensive sectors are taking a bit of a backseat with all this short covering and massive risk on rally which we are seeing. And this risk on rally clearly comms, discretionary, and tech are outperforming this obviously in the short run. Um, and youths, staples, and healthcare are lagging in terms of relative strength or just in terms of absolute performance. Now, obviously, if we get to see some down days in a row, then the picture could easily flip. But when that would happen, we don't know. And until then, the markets keep treading higher.
And it's a great point, Trent, just to piggyback off that. As you're going through and looking at these and you're working in your notebook, that's the importance of tracking like the day over day performance and seeing if market's up or down, how are those components acting? Kind of going back to my commentary around utilities here, which although positive on the day, not as certainly did not perform as well as other components, like tech today, right? Like XLK. So keep track of on a down day what is outperforming. So if I go back to what was that, the 30th, where the S&P was down 1.3% day over day, your outperformers were XLP, XLU, XLF, XLB. And XL and communications in that light. So just piggyback off in terms of like worst performers on Monday, it was XLE at minus 2.25, 2.29, XLK minus 1.91, XLY at minus 1.70, and XLC at minus 1.57. So, it's a great point, Trend, right? So tracking on both sides, what's performing well on up days, what's performing well on down days, and what kind of style factors and what kind of style factors are also having the positive correlation in terms of an up day and a down day. And this is a key thing here in terms of trying to pivot the portfolio or manage the portfolio and manage what you have exposure to, and trying to mirror that or align that with what's working on either a trade basis and or trend basis. And again, it just depends on your investing style, on the way that you deploy capital, and whether or not you're trying to capture the more immediate term trade component, or more the trend full investing cycle component of things. So good commentary there, Trent. I think that was, hopefully folks found that valuable.
Yeah, I did want to add on that factor aspect, right? So outside of the sector as a factor, one should also consider looking at relative strengths of things like momentum. So the easiest ticker to look for that is MTUM. And this is the momentum in the classical sense, meaning the 212 momentum, or the go back 1 month, start from second month all the way to 12th month, rolling 12-month window sort of a momentum. So that's one. The second one is size, SIZE. That's the other ticker. Also, the domicile of the tickers is kind of a factor, right? So, for example, international right now is giving you much more juice as compared to US up until this week's rally. So, up until last week, international was giving you so much juice that you literally didn't have to bother yourself with what's about to happen in US or economic data in US. You just could buy a broader basket, like what I did with the BBEU about 10 days ago, and call it, just that's it. So 2 weeks ago, I got BBEU basket for my overall international allocation. Of course, I did not fill out the all of the losses from the European put verticals from options, but it did give back some losses from that because it just outperformed like crazy. And then the other part was AAXJ as well as EWJ for Japan, and then Asia. Some parts of Asia are doing really well, and Australia. So international domicile could also be used as a factor. So MTEM, uh, or you could go as broad as just using some of the Vanguard ETFs. Right, Vanguard has extremely liquid, fairly large ETFs which one can utilize. And I know that for folks who are on this call, some of them may have liquidity constraints. So, for example, for a classic RIA who has, say, about around, say, 100 million, just putting round figures out there, you want to trade in something which, in the 390 minutes provides you an easy ability to get in, get out with a 1% position. That comes out to about $39 million. So you could do 1% in and out rather quickly. Now, if you look at the daily value of the 4,800 plus tickers, or even some of the tickers that we get in RTA, they don't have 40 million daily value traded. So if you narrow that down, it comes down to just like 250 or 300 odd ETF tickers that which give you around like 25 to 40 million plus sort of daily value traded. And in that space, you'll find a lot of iShares ones or the ones from Vanguard or the one from JP Morgan, etc. If you just run that kind of a filter from ETFDB, you'll find that there's good 300 tickers that would allow you that daily value of 25 million plus. Now, for broader community who don't have such liquidity constraints, it doesn't matter, right? You might get your alpha because the ETF is less liquid. It happens because you may not have automated trading bots who are trying to swipe you away from your position just because it's extremely liquid or it's extremely large. So this is again not an investment advice, just giving a sense of for who what kind of tickers are important. So definitely explore more tickers, get a sense of which factors are exposed through which ticker, study them carefully, and then have a playbook ready that if this happens, this is how I need to position. If that happens, this is how I need to position, etc.
Yeah, and
Back to you, Rob.
Trent, great. So again, there's a dashboard. It's called a market dashboards. There's a dashboard in there called factor analysis on Koifin that I do leverage a decent amount, and it's pretty great because it's an easy. The dashboard's already created, and it does a relative basis on a relative performance. It will compare things like value, so IWD to SPY, right. So you're comparing factors to the performance of the S&P. And if you go back on a 3-month basis, on a trending basis, because that's personally how I like to look at things. I like to, have a component of what's transpiring on immediate term, but really what kind of pivots are happening on more of a trending basis. And if you pull that up, so if you go to Koifin, it's a free platform, and the best relative performance is values, IWD to SPY, but only by 22 basis points. The worst performing from a style factor standpoint is momentum, and it's actually down negative 8.44% compared to SPYs. So again, Trent, just to piggyback off of what you just said, not only understanding some of the underlying components inside of those holdings, but also what factor is performing well against the SPYs and again on different time frames. So on the last 1 month time frame versus SPYs, small cap, aka IJR versus SPYs, is up 3.53%. So in the last month, that's been a better relative outperformance. But if you also go down the list, quality has been a pretty strong outperformer in regards to whether especially on a 3-month basis, up 2.75%. So again, just going down that list and understanding kind of what's working on a relative basis as well as what's working on an absolute basis, and kind of diving in a little bit in due diligence in the last month in terms of best kind of relative outperformance in regards to size, it would be mid cap value. at 5.58% of relative outperformance. That's the IJJ ETF. So I believe that is from Vanguard as well, trend. But again, just kind of, evaluating these things, looking at how using that. So if you see mid-cap value, if you've got individual securities in your portfolio, how does that align with from a factor exposure, a sizing, a from the qualitative standpoint, whether it's quality, hedge funds, private equity, IPOs, how are those performing well? And IPOs on a 1 month basis are up over 11.5%. So on a relative basis versus SPY. So those have been, massive outperformers. And how do you kind of take that and meld that into a portfolio construction? On a 3 month basis, IPOs though are still down, negative 1.37% on a relative basis. So, underperforming on a 3 month, outperforming on a 1 month. And what that tells me is, whether it be, short covering as I think Trend kind of alluded to, or just the SPYs are relatively, there's not really a clear direction from a style factor standpoint that's really on a trending basis going back 3 months, aka going back to November timeframe in terms of real strong outperformance, especially against the SPYs. It's really kind of a relatively muted sort of signal there from that standpoint. All right, so we've been chit-chatting here for the last 45 minutes or so. If there's folks that are out there in the crowd, if you'd like to stand up, ask any questions, happy to engage. Trent and I can also just keep going back and forth. We do that frequently as well. But we're here to help, right? I mean, I know it's been a frustrating frustrating start to the year in terms of, we've been taking the other side of this price action and it keeps going up. And so we're here to help. If you need a vent, if you need a shrink, I don't mean that in a condescending way at all. I just mean we're here to help, right? Like this is a community. We're here to convey our kind of concerns, what we're seeing from a signal standpoint. If again, the theme here is the notebook, so let's stick with that as a core principle, but also review and kind of convey any message, any kind of issues that you're feeling, or from an execution standpoint, and go from there. Does that make sense, Trent? Did I convey that okay?
Yeah.
Okay. Don't everyone jump up at once. I guess everyone's cool.
Yeah.
All right, Trent. Oh, there we go. We got Leslie and X2. How's it going, X2? I think you came up. Bill's coming up. Awesome. So why don't we, Brad? We got a few guys coming up. Awesome. Let's do this. X2. I don't know. Hey, man.
Oh, there you go.
How you doing?
Sorry,
man?
I was just busy loading up on tech stacks and stuff. So
Oh, good.
Couldn't jump on.
Just piling them up, right? Loading up the truck.
Yeah.
Yeah.
That and some 0 day to expiration options. Yeah,
Perfect.
been a lot of fun.
What exactly? I know you often have, I know you focus on currencies frequently, but I don't know if anything's jumping out at you in the currency market at all.
No.
Okay.
I'd rather not talk about that.
All right.
Yeah, it's been a rough few weeks. But I am curious, what the dollar risk range, and if he finally switches to neutral. But we'll have to see tomorrow.
Yeah, it closed just below the low end of the risk range, which had been putting in higher lows for a number of days. So U.S. dollar had been inching up the list in regards to, for instance, this morning, put in a higher low and higher high at 105.01. So and so it was 101.37. So the signal again, it was circled this morning, and I think if we go back to kind of an execution standpoint, and if this had been a day that wasn't an FOMC day where folks weren't focused on Powell and the rate hike and that kind of thing. This would have been, to me, I would have classified this as a gift in regards to things at tops and bottoms of ranges, in regards to things that we want to own and or short. So that's kind of perhaps the way that I'm looking at it a little bit here is I'm absolutely on your page X2 in regards to, what does that risk range look like tomorrow? Does that low end of the risk range really move significantly lower, or does it kind of keep in here at that kind of just above 101 range type of thing? And then more specifically, what does that top end of the risk range look like on the dollar? Because it was 105.03 this morning. If we go back a week, what was that? The 26th, maybe? Is that right? What was it a week ago? Sorry, pulling up the calendar, guys. 25th. So the 25th, it was 105.27. So again, on a day-over-day basis, higher high, but on a week-over-week basis, it is a lower high. So what does that look like tomorrow? Because, and I've said this a number of times, looking at things day over day, as well as week over week, does put things in perspective as to like where we've come from. But dollar still is an outperformer in quad 4, and that's the data on the horizon. It's just a matter of when does that get a bid, and it had been getting a bid.
Yeah, we also have the ECB tomorrow morning, so that should throw a wrench into things.
Good call out.
Yep.
And we've got 222. We've got jobless claims tomorrow morning at 8:30, and non-farm payrolls on Friday at 8:30. So it's a big economic data week, and those are the kind of next two that I'd say are relatively large ones on the horizon. So just put that in your notebook or jot those down. So jobless claims tomorrow morning at 8:30, non-farm payrolls Friday at 8:30. All right.
Thanks.
Yeah, of course, buddy. Let's I'll just a number of people jumped up. So Bill, I don't know, Bill, Brad, Eric, whomever wishes to. Eric, you looked like you were undoing your speaker. If you wanted to jump in, by all means, happy to.
Yeah, my question was when they were testing or back testing for quad 4 were they using telecom or were they using XLC? Because XLC has changed so much in terms of what its components are versus the last set of quad 4s.
Yeah, Eric, that's a really good question. I am on the slide that I'm looking at. It says telecom. So I'll find that details and I'll tweet it out. Eric, I don't know that off the top of my head, or I don't know that. So I'll before I misrepresent, because it has obviously shifted a ton. And again, as I mentioned earlier, Google's 22% of the makeup, right? And it's bearish trend. So, but also just the holdings and other components are worth reviewing. And if you can only own ETFs and not any securities, if you go through Freeman's list, it does have a lot of things that he is relatively positive on, and therefore it can be from a fundamental standpoint, along with near-term absolute performance, and something that's gaining kind of signal strength could be something to. Again, I'm not saying go buy it right now. It's just something to be put, to put on the board behind you in terms of, hey, how is that performing? How is that doing?
And to add to it, Eric, there's also another ETF called XTL, which is specifically for telecom only. So it houses more proportion of tickers such as Verizon, TMUS, AT&T, so T, as well as several others. So that ticker is XT as in Tom, L as in Lima.
Yeah, no, I found that one as well. And that's the one, as I was doing my modeling against, quad 4, every day I try and say, is this a quad 1 day, a quad 2 day, a quad 3 day, and sit there and say, where have we kind of moved? And then, think about how it's going to flow back to quad 4. And that's the one that I have been using as opposed to XLC, because XLC has so much tech component in it at this point that that it's, I don't know how much it is really about communication or telecom.
Yep.
But it would be interesting to me to understand in the back tests whether or not, they were using something like XTL or if they were using XLC.
Yeah, I'll ask Rich here.
I think they don't use the ETF tickers. What they use is the GICS level mapping. So if you take a backtesting system such as CRISPR or several others, right? They would allow you to do a backtest using proportionate existing tickers which are there at that point of time for that specific GICS classification. So, and the composition of these 12 major ETFs, right? The SSGA ETF, State Street ETFs, such as XLF, XLP, etc. All of those are just following that GICS classification level 1. So it almost works out to be kind of similar, except for this telecom bit, which you're asking. So telecom is actually a subsector within XLC, meaning I don't want to call it XLC. I want to call it GICS level 2 classification is telecom. So maybe when Rob checks out, Rob can check out whether he's saying telecom as GICS level 1 or GICS level 2. And for everybody's interest, GICS is GICS. It's the Global Industry Classification segmentation, which is done by when I was studying my CFA, I came across that long time ago. So the GICS classification is usually how these tickers are classified in the S&P 500 or in general for all tickers listed in US as well as globally. It's a global classification system. I hope that helps.
Yeah, that helps. I'm just looking for some place to add some more data.
Yeah, because if you look at XLC,
that we currently have.
Yeah, because if you look at XLC, right, it has telecom, then it has media separately. So if you look at tickers such as Warner Brothers, Discovery, or a few other names like Match Group or whatever, all of those are actually more on the media side. So media, internet, telecom, those are subsectors. So they are level 2 classifications within the broader XLC, which is for communication services.
So real quick, is anybody doing the beta adjustments as, so I know that we're supposed to, size positions according to beta.
It's pretty straightforward. It's pretty straightforward. So what you can do is just, let's say if you have 10 tickers, I'm just making this up, then lay them out in a row in your spreadsheet. Then you have your beta column and you have your weights column. Okay, so you have to solve for the weights within certain constraints. So you can use solver within Excel in order to get your weights. When you're doing this incrementally, it's relatively straightforward and easy. But if you're trying to build a new fresh portfolio and you want to stay low in your beta, so for example, you want to stay close to 0 or 0.1, then you'll have to adjust using the beta of your tickers accordingly. So let's say if you're RIA or if you can't go short for whatever reason, right? But you are using some ETF ticker with negative beta, such as SARK or such as SJB or such as some other ticker which has negative beta. But if it has a huge negative beta, like -2 or -3, then you would want to reduce your weight accordingly, right? And it would automatically get resolved in that problem solver, or you could just key in yourself and do trial and error on the Excel, there's multiple ways of doing it. But it's pretty straightforward exercise in Excel. It's not that complex to do beta adjustment.
Yeah, no, I'm just wondering whether or not people are doing that within their portfolios, because I look at the Macro Pro list of ETFs, and the average beta, or the weighted beta, according to what I can decode from what he said in terms of his overall positions, is so massively different than the set of core shorts, that we talk about.
So keep in mind
You know,
something which Chanos once told me. So Jim Chanos was a famous short seller. I had once the opportunity to ask him questions almost for 20 minutes straight. It was actually in one of these spaces, not this one, some other space. But so one of the questions I asked him was exactly what you're saying about the core short positions and how he manages these things, etc. And he gave an interesting answer. And I had heard him once speak at Columbia, and that time he had mentioned this, but I kind of missed it at that time. So on an average, he has about like 35 to 40 positions. Okay, and not all of them are short. He has a hedge book, which means that, for example, just I think today or yesterday in some interview, he was talking about his AMC short. He's short AMC common, but he's long AMC preferred. Okay, that itself neutralizes his beta significantly. Second, any given day, his short, let's say on Tesla, would range anywhere between 0.5% to 5%. So while you were short Tesla for 3 to 4 years, and when it went up, he kept on constantly risk managing it, right? So keep all of these factors in mind, right? Like it's not like, okay, you got one good idea, you jump on, full commando 5% short on one. And I've heard of some people going 10-20% of their portfolio short on one name, and that's just absolute recipe for disaster. Now when you aggregate all of your shorts, right, you need to be careful of where do you want to land. Is it going to be 30% short? Then okay, if you have 20 ideas, then you can't go more than 1.5% each name, because a propose, meaning a priori or before the event has occurred, I don't know how much percentage I'm going to go give to which short, except for the beta. Beta is given, right? It's not a variable. Beta, what the beta is. So if the beta is high, then I can't give it 1.5%.
yeah,
I'll have to give it less if the beta is more, and it depends on where my stop loss is. So stop losses is another concept which I want to bring up, right, for the broader
Trent, just
community.
before we move on to stop losses, which I think is a really good subject matter. The other component, Eric, there too, is it's beta adjusting, but really volatility adjusting the position, right? So using that realized vol or historical vol, really any component of volatility, to be perfectly frank with you, but the adjusting those, that's when in terms of position sizing, that flows more into the volatility of the underlying component. There's kind of two different components here, right? In regards to beta adjusting and volatility adjusting, which helps with the sizing side, right? So if the differences between shorting something, I'm just using short as an example, something like an HYG or J&K versus a QQQ. J&K, HYG has, I'm rounding it off, but about a 10 realized vol if you use kind of like a 30-day look back. Qs have about a 30 realized vol. So those that means really at the end of the day, you can have a 3 times, your position in your short position HYG can be, again, from a volatility adjusting standpoint, it's not a straight 1-to-1, but just from a simple math standpoint, let's just call it a 3-to-1. So if your max short or min short on is 1%, you could have 30 basis points for Qs, and you can have 1% for HYG, right? So I think that's also a component there in regards to the volatility adjusting things as well as beta adjusting.
Right, and that the way, at least for me, it flows into my stop loss mechanism is through weights of the position size. So for example, using water mechanism, let's say if you bought a ticker at 100 price, right? And for a similar other ticker, because its volatility was higher, you had stop loss of say $80. And for the first one, you had a stop loss of $90. And if your risk capital you want to keep as same for both of them, meaning you don't want to lose more than say 0.5% of the book on each one of them, then you'd literally have half the position size in terms of number of units of the ticker which has a deeper stop loss. Does that make sense?
Yeah, no, absolutely.
So usually, otherwise, what people do is, oh, I'll buy 100 shares because why? Because 100 is a round figure, and I'm like, no, that's not how you position size yourself. You have to determine how much of the size of your book you're willing to lose on each of these trades on an a priori basis.
Yeah, no, absolutely.
Awesome. Great commentary, Eric. Feel free to stay up here and we can kind of, you can comment and what have you. There was a question on Twitter around the ticker for Philippines by Angry O'Neill. That would be Echo Papa Hotel Echo. So EPHE. Echo Papa Hotel Echo. I hope that helps. Bill, always a pleasure to have you on.
Hey, Robert.
How you doing,
good
man?
job showing up today, man. It can be a rough audience sometimes, and sometimes it's real, man. It hurts. So if anybody's out there hurting, know there'll be another day, right?
Absolutely.
Yeah, you brought up some notebook stuff. So a couple of things that really have been catching my attention over the last, especially 5 days, is just Euro USD. It hasn't had a lower low in 51 days, right? The GP USD has only had one lower low in the last 17. Canada USD has had two lower lows in the last 20, right? So when it's why I've been one of the reasons I've been a little cautious lately. And SPX has had higher lows for what is that, like 12 straight days, right? Now, obviously, SPX is going up, but that's what's really caught my attention in the notebook for a while. And so I'm sure other people are seeing it too, but wanted to call it out in case some folks missed it.
Yeah, great work. I appreciate that. And Angry O'Neill, you're very welcome. Leslie, how you doing?
Howdy. Couple things. I just wanted to add to some of the other things we've talked about. First was on Dixie. We tagged the last trend level that I have recorded from Keith. So 101 spot 12. We tagged that today. So that was tail. And he gave that a couple of weeks ago. It must have been on a show.
Yep. Great call out.
So yeah, and when he says those, I just slap a line on a chart and label it. That way I can see it when it comes up.
Yeah, I believe he said on the show, and I think it was even in an early look, if memory serves. Let me go. It was on 123. Yep, 123.
Yeah, that sounds right.
I believe on the early look, he gave both tail duration on the dollar and tail duration on the euro. Just as an FYI.
So we wicked under.
Sorry, not tail duration. Excuse me. The tail level. The tail
level. Yeah.
Yeah. Excuse me.
We wicked under and we settled above for closing price. So we closed at 101.15 ish, and it's still going. Closing was 101.14, and tail was 101.12. So we're there. Now we see what happens. But I mean, it hung just above that level and just below trend for 2.5 weeks, 3 weeks there. So I was kind of the opinion that you don't come that close to a level and just hover above it without tagging it at least once. So kind of makes sense.
Yeah.
They're magnets. They
are.
The level is there. We're going to hit it.
Yeah, that's right. You've been around long enough to know that, right?
Yeah. No, you draw the line. Eventually, you'll tag it. Yeah.
Just like you should, it wouldn't be surprising if we go tag the trend line on the top side as that which is now resistance, right?
Exactly.
Yeah.
Yep.
Exactly.
Just draw some lines. Watch the magic. Yeah. So I just wanted to point that out, that we haven't broken anything critical. We're just there.
Yep. Great call out.
As far as I've been watching. And then talking sectors, and ETFs, and I've long wondered this, and we've talked about this before, but XLU is still more than 16% NEE, which has been just obliterated the past couple of months. And I still don't know why we don't use RYU for the equal weighted, because XLU is not performing the way you would think, because it has that huge percentage of a solar company, or or an alternative energy
Next
company.
Data, right? Next Data Energy, yeah.
Yeah. And so if you're going to check out the whole telecom thing, maybe bring up the XLU weighting to NEE being odd. It's not very useful, and that I think that was one of the first ones where we had the discussion. Must have been earlier this year about the components of ETFs, and we started picking them apart, and that was one that came up at that point.
Yeah, I mean, unfortunately, you could say that like amongst a number of ETFs like XLI,
right?
XLK, but your point is
well,
and
they have
and
become,
for those that don't know,
they have become unweighted. Yeah.
Yes, and so the ones, for those that are, that either whether it's a reminder or are newish to the weekly notebook review, whatever the component, but Invesco has a number of equal weighted sector exposures across the board. Whether they have equal weighted REITs, equal weighted, pretty much every sector they have it. So it's listed on their website under ETFs. RYU is the ticker for utilities.
Right, and that's been performing
Romeo Yankee Oscar. Not Oscar. Uniform. Uniform. Romeo Yankee uniform. Yeah.
And that's been performing a whole lot more like what you would expect from utilities. So
Agreed.
I thought I'd bring it back.
I hadn't pulled that up in a minute. You're absolutely correct.
Yeah. That one is stuck in my head since that last discussion, however many months ago it was. That XLU, it was great when solar and alternative energy things were flying, but now that they're a little more corrected, it's not as great. So.
Absolutely.
Oh, and hey, do you know off the top of your head what was Keith's water ticker that he was talking about? C something.
CDZI, I believe. So Charlie Delta Zulu India.
I was listening while I was walking the dog. I didn't have anything to write it on.
and again, I am not. I have no affiliation with Invesco, but they also have a water ETF called PHO. So that would be again.
There's another one called V Water VWTR.
I don't know what's inside of PHO or
no idea.
But so that's Papa Hotel Oscar. But again, just like if you, I believe CDZI is an actual. I think that's an actual individual company, but I could be mistaken. I didn't actually look at them.
I was just curious. I knew you'd have it written down. That's all I had. You're my note taker.
That's right. I got one thing going.
I listen to these recordings walking the dog a lot. So
I got one thing going for me, Leslie. I can take a note.
More than that.
Adam, pleasure to have you back on, man. It's been a minute, but.
Yeah, it's been a while.
How you doing?
Good to hear from you.
Good to hear from you too.
Good.
What's going on in your mind?
Yeah. Well, I do want to take us back to the dollar. For quite a while now, I've been monitoring the risk ranges versus the bridge bands study that you can use in which one is this?
TradingView.com.
Yeah, actually, no, I'm using it in TD Ameritrade. What's it called? Thinkorswim. Yeah, excuse me. Anyway, I can replicate the daily ranges within about 1%, and I'm talking 1% of the range. It's super accurate. Those daily ranges, I can bring them up on a 1 year, 1 day chart pretty perfectly. Now, the tail ranges, I believe, are 3 year, 1 week ranges. And what's really stuck in my craw right now is, despite what Leslie said about the numbers, if you look at that chart, and I posted it behind in reply to one of Trend's posts. So I don't know if you can see it or if everybody can see it. But if you look at that tail duration chart, the thing has been basically bullish the euro and bearish the dollar since the 12th of December. And, Keith himself, love Keith, love the process, and I believe he's built a process that's bigger than himself. But honestly, if I just share my left-hand column, I believe he's fudged the numbers because he's been clouded by his own beliefs. And we should have let the data speak. If we'd all followed the data, some pain could have been saved for some people. There's a guy on the community forum, Joe Danter. Sounds like he's lost 5% of his portfolio in January because he's been following this stuff without other tools to check and balance. Now, if you go look at the SPY chart, it's even worse. The SPY chart has been bullish, absolutely slam dunk bullish on a daily basis. So the 1 day risk range. So I'm just kind of calling bullshit on the ranges we've been given. They've been the right size, but they've been the wrong direction.
I don't. I really have.
It's pretty irrefutable. We could backtest this, and we bloody should.
Yeah. And
if you take all the ranges, in fact, there's people in the community that do this. It just doesn't add up. I think that, he was just very, very committed to a direction. Oh, we can complain about, the Japanese situation, blah, blah, blah. But this is worse than his XLE call last January.
So I would say, Adam, so I know there's different components, right? So in terms of going back in terms of, and I see Reed Rob's out there as well, so maybe he can come up and speak in terms of some of the things that he's seen as well. But anyway, the components there in regards to the risk range themselves. So there's different durations for various things. The Bollinger Bands are not. Again, I know you may get quite close to approximation, but there's.
Yeah, I'm not using Bollinger Bands. I'm using the Hurst exponent from Mandelbrot's book.
Okay.
Which is the basis for Keith's as well.
Adam, I don't really. Unfortunately, I'm not intimate with Keith's model, so I can't really answer that. So that's about it. I'm sorry. I wish I could give you more, but I just don't. I don't have it.
Well, I think this is the unsaid question on a lot of people's mind. I read through the arena and all the rest of it. Keith himself, get the dollar right, you get everything else right. We got the dollar totally wrong.
So again, I'm going off of the levels that Keith has provided, and we're at the tail level right now. So I'm not sure, Adam.
Hey, Rob, can you hear me? Hey, Adam. Hey, Adam. Just a thought. Hey, Rob here. Just a thought.
Hey, Rob.
Hey, good. How's it going? I hope you're having a nice evening. My suggestion would be to wait for when Keith is maybe here in the space to let him be the one to address those questions, not let any of us do that, just so that he could be the one to, either refute or affirm what you're saying. I don't know, just my suggestion. I'm not saying you're wrong. I'm not saying you're right. I just think he would be the best one to address that.
Well, at the end of the day, the numbers are on the tape and the risk range data is out there. This can absolutely be demonstrated with the data. And I think it's worth a look. I believe in the process. I genuinely think that Keith applied a bit more art than science here, and he got it wrong. That's just my view, and I think it's the view of quite a lot of people.
And that's, again, this is no perform or absolutely, I'm not trying to defer the commentary, but I'm going to lean towards, I think that's a good comment very good comment by Rob in terms of, I'm going to defer and invite, we can try to have an open forum with Keith and review, but if you don't mind, Adam, again, I'm not trying to pivot away from this conversation, but if we can, if there's other folks that have any other additional questions or what have you, if we can kind of, again, because I just don't have an answer, man. Right. So I have nothing. If that's the way that you, again, like not you, but like if that's the commentary or the feedback, then we'll review. And again, Keith's not a shy man. He's not going to, walk away from a conversation and to help walk people through the, how he's getting to those numbers and what the dollar signal is looking like. Because again, you're quoting him in regards to, get the dollar right, you get a lot of things right. And he said that multiple times since I've been following the process. And I think he'd say that right here on this call. So let's just let that, let's kind of, if you don't mind, we'll pivot a hair and get back to the notebook and what have you. Well, since we got Rob on, I know he's probably deep in the works in regards to analysis of anything that's happened. Reports.
Well, yeah, I'm actually gonna drop off in a second. I had MAA just report. Looks okay. I'm still parsing it, but I don't want to deflect the conversation. I just dropped in for a second and was listening, but I'll let you guys to it.
No, totally. Yeah, we keep. Coach keeps going to the wood on a number of your names, and I think there's good reason why, but we don't need to get totally into that right now. But look for Rob and I will be sitting down not tomorrow, but a week from tomorrow, and doing a sector head spotlight discussion where we'll get deeper into his process and how he comes up with names, and his general coverage universe and some key themes that are going to be happening. So I'll plug that for us, right, Rob, and we can pivot here, get back to the conversation. But yeah, Bill, I mean, I don't think I cut you off, but was there anything else kind of in your mind right now that you want to talk about? So Gavin's out there as well. I don't know if you can jump up, but
I'll just comment a little bit on what that guy just said. One thing is Keith's models, we know, really take into effect the quads we're in, right? And so that's one way. Keith can represent that in the conversation, though. But I've thought a lot about it in all kinds of different ways in all kinds of different situations, right? It's really hard. There's a lot of calculations going on there, and I'm sure Keith would explain what's happening. So, but it's a good thing to help us to understand sort of his process too, because there's a lot of reasons that investing's hard, and trusting your process is at the top of it, right? And so, he's been great at being super wide open and really explaining things to us. So I really appreciate his approach, and I appreciate how he's been teaching me for the last couple of years. And so, I really think, I think in many ways he's been very groundbreaking for me, and I hope for others too. So that's all I got.
Hey, did we lose Rob? I wanted to ask him a quick real estate question.
He did. He had to go work on his model. Yeah,
okay,
sorry,
no
Trent.
problem.
He is in the office here with me, but
oh, that's fine. Maybe.
No, you're good, Rob. Yeah, don't worry about it. Well, but
Rob's always good.
Rob is good. He's great. I'm looking forward. So tomorrow, just in terms of sector head spotlight, is to kind of take a moment before Poking the Bear comes on in comments. But I've got the consumables team, the sector heads of Daniel Bielsi and Howard Penny tomorrow. So that'll be at 11:30. So looking forward to kind of diving into their process. You get a 2-for-1 special with those guys, where we'll cover both restaurants and staples and cannabis as well. Can't forget the cannabis, but we're going to focus primarily on staples and restaurants tomorrow. So it should be a lot of fun. These are going to be happening on a weekly basis on Thursday mornings. So keep looking out for those as we move forward. But Pokey the Bear, how you doing?
Hey guys. Hey Robert, you're doing a great job.
Hey,
I just want to hop up real quick. I've been a Hedgeye subscriber since late 2013. So while I haven't seen a real bear market with Keith, I have a pretty good idea of the process, and I've watched it evolve. What I would say is two things. One, and I'm not here to be a cheerleader. I'm just trying to be really objective with everything. Keith gets you out, right? I mean, that's the biggest thing. It's the risk management. It's getting you out, right? And even if you got back in now in Facebook and you sold back in January of last year, you're still doing really well. Like I ran the numbers on Alibaba. My average selling price on Alibaba was $175 a share, and my average cost basis now buying it back is 110. Like in the long term, things work, and bounces are tough, man. And I think we all just sometimes get caught up in looking at the day to day stuff, and at some point, this is all going to fall apart. At some point, we know Keith is going to say, I was right. But in the short term, there's going to be pain there. And I think it's really we all need to remind ourselves that at the end of the day, it's up to us to make those decisions. And I'm not saying that Keith's process is right. I'm not saying it's wrong. I'm saying I believe in it and I follow it and it's worked for me. But what I'm saying is we all just need to take a step back, take a deep breath, and kind of look at where we are and what do things make sense. And it's not about understanding them, but does something make sense, or what's coming next, and just kind of saying, where are we going to, and is that where we are right now?
No, that's good stuff, man. I appreciate it, and thanks for jumping up to share your 2 cents. Cool. Well, with that, we're going on an hour and a half. I think maybe we just end with the wise words from Pokey. Auto Trend, what do you got? Anything else that we didn't cover? Leslie? Bill? I think we did a pretty good job today.
No, I was just going to add that, let's say if you're playing football or basketball or baseball, you know how coaches tend to have a large playbook of strategies. Similarly, for one's own portfolio, one should have a large playbook of strategies, right? So, for example, I think, Rob, you and I, we did last January in 2022, we did one interview. And if you go to Rob's YouTube channel, you'll find it. I shared about a whole bunch of strategies that I usually tend to deploy depending upon what regime exists. So if the regime is having a certain set of VIX term curve, right, then I would deploy a certain strategy. Otherwise, a different one. Now, you can be super dynamic or you can be super passive. And either way is the way you utilize the research from one source. Because at the end, if you own the accountability for your own portfolio, then there's less reliance on just one source of research, right? You could get your information from like 50 different sources of research. I'm being hyperbolical here, but you could get from as many sources as you want, and then try to distill it down to what becomes your portfolio strategy. Or your portfolio strategy could be independent of all of them, like the multi-strategy portfolios, right? So if you look at Citadel, if you look at Millennium, and these folks kind of outperform the broader market or even the hedge fund world. Because if you look at hedge fund world, the long short hedged equity index on hfr.com or hedge fund research indices.com clearly shows that long short book last year in 2022 yielded on an average negative 8%. I'll repeat that. A hedged long short equity strategy yielded on an average, this is average of the hedge funds who do report to HFR. Not all of the hedge funds report, but whoever does report, which is a good sample set that they have of the population, was minus 8%. The only thing that had double-digit positive was the trend following index ones, because they were able to catch, going short on bonds, going short on equities, etc., and they were able to catch that good trend. Also, keep in mind, trend following can be fairly, it can bring in huge drawdowns in a single month, because in November they had a bad month. So understanding what different strategies one can deploy in the portfolio, and then bringing all of those on creates less reliance and less frustration too, because then you're not reliant on just one source. However, I must admit that of all the sources I have, I do tend to get the most value or the most distillation of information from this source, from the Hedgeye source. So just admitting it after, trying out 50 or 100 different sources of research without any bias or without any, I'm an independent person, right? Like I'm an independent subscriber, like all of you in the community. I'm not employed by Hedgeye, or I'm not, having any sort of arrangement with them. Just sharing this very objectively that having multiple strategies creates less frustration, because some of these strategies might be your own independent ones, which you discovered through your own research, etc., or whatever you feel like should be your strategy, right? So, for example, somebody discussed about bridge bands, or somebody discussed about something else. Fine, you deploy that capital, do your journaling, and at the end of it, come to a conclusion. Okay, this strategy works. It's not something prescribed by anybody else. It's something I found on my own. Deploy it. Put some capital. If it works, increase your allocation. Right? This is exactly how Millennium operates. It's a multi-strategy hedge fund or pod shop. It is exactly how Citadel operates. It is exactly how many other multi-strategy funds operate. So just think about yourself as that, especially if you have bandwidth. If you don't have bandwidth, then you can have a passive portfolio with a little bit of tilt, using this kind of one source of research strategy, or you can have 2 or 3 different sources and listen from all sources and come to your own conclusion. But finally, having your own accountability to win your own game, be it basketball, baseball, football, or investment, it all boils down to owning the game yourself and owning the playbook of strategies. Back to you, Rob.
Yeah, I just wanted to, I totally agree with you, Trent. Like, there's different strategies. Also, just adding some other signals that may make you more and more comfortable with sizing, right? And we're all responsible for our own trading, and trading itself is hard. You could have the best information in the world and not trade it well, right? So that's also a skill to learn, to your point, through the journaling and stuff like that. And I'll just say for the record that Trent Wizzo does have the best Twitter handle on here. So I want everybody to know that.
Thank you, Will. Thank you.
It's only because Jimmy Runs Money isn't here, though, because I still put Jimmy Runs Money first if he was here. I'm sorry.
I love it. To your point, how you doing, man? It's been a while.
Yeah, man. It's been crazy busy, especially at work. So I know you guys were talking about, I think, the Philippines earlier, and I actually wanted to come up, but I was trying to finish up work, actually. But there was something that I actually wanted to touch on that I don't think should be discounted, and like, at least within the emerging market space, and that's Turkey. I posted something up in the Nest, actually. On a year-over-year basis, Turkey's up. It's the graph in the Nest is transcended, but I think it's up like 193%. So there's actually some very interesting geopolitical implications for this. So Turkey has kind of, and I don't like Erdogan, but he has done very well in terms of strategizing. So like with stuff going through the Black Sea, whether it be from Russia or the Ukraine, he's played both sides of that conflict very well. And so therefore, trade throughout the Bosphorus, which would be, Istanbul, et cetera, is up massively. And so, I think from an emerging market standpoint, along with, I think, the Philippines and Vietnam and Indonesia and Malaysia, just because China's outsourcing to a lot of these nations, because, China's having a nominal wage crisis. I think that Turkey's another place that people should look. And kind of what I was saying about this is, I know people are worried about the lira, but 3-month implied lira, like the volatility on the lira has cheapened relative to realized vol. So you could actually use that as a hedging basis. So I just wanted to say, I don't think Turkey's off the table. I think that it could still deflate because it has run up massively, but and they have an election coming up in May. But I think that broadly speaking, Turkey's still a place that I think is set up to do well.
Well, I appreciate that. We actually got out of Turkey a week or so ago, so was certainly good timing on our behalf before things fell out of the bed here. But yeah, no, I mean, it definitely was a place where we thought, again, it had good quad environments, good economic data was coming out of it, and the signal certainly agreed. So the signal kind of pivoted here recently, to your point, but it doesn't mean that we, if it holds or kind of moves back above trend, doesn't mean we won't get long turkey again. And I actually forget how much it makes up of the EEM exposure. I know it's in there, but again, emerging markets in general is something that we've recently kind of pivoted long to. So, but yeah, man, no, Turkey's definitely been on our radar for quite a while, which has been great. All right, Jason asked to come up to speak. Hi, Jason.
Hey, Robert. So I just joined. I noticed that the dollar index today kind of fell below the risk range. I don't know if you guys kind of covered that already. I don't know where his longer term tail trend is. I'm really just wondering if you guys covered that, and if you did, what was the commentary behind that?
We did, Jason. So rather than kind of repeating it, if you just join, if you don't mind, you can just listen to the replay. It was kind of 3/4 of the way in. But to answer your question, the tail level is 101.12.
Thanks, man. I'll check out the replay. Thank you.
Yeah, no worries, man. Yeah, so we just so it closed kind of just above that tail line.
Cool. Thank you.
Yeah, you got it, boss. Awesome. So yeah, so why don't we wrap up? I'm getting a little hungry myself, to be perfectly frank with you. So I think in terms of the next week, we'll be back 4:30. It's going to be our go-to spot moving forward. So 4:30 on Wednesdays. Obviously, they may have to pivot here and there, just depending on schedules and that kind of thing. But for the most part, this is the time slot. So keep that in mind. We'll be back next week, Wednesday, 4:30 in the afternoon here on the East Coast via Twitter Spaces. Beginner's Guide will air on Friday at 11:30. We've got Sector Spotlight tomorrow at 11:30. And for those that aren't, that'll go to Hedgeye subscribers. Both of those go to Hedgeye subscribers. And then we'll release Sector Spotlight on YouTube. So if you're not a kind of subscriber, what have you, to the Hedgeye YouTube channel, by all means, go do that, and we'll release those Sector Head Spotlight videos on Saturday morning. So a little bit of a delay there, but appreciate everyone who came in, who joined via listened, participated. Great conversation today. Trent, Leslie, Bill, everyone else. Other side was at the beginning. Appreciate everybody who jumped on, shared their thoughts, and just stick with the process. And we'll keep helping to have these conversations, open dialogues on a weekly basis, and go from there. But let's rock and roll, folks.